Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks. And today what we're going to do is take a look at 3 different ways to scale into stocks. Now, there's many more ways than just these 3 ways, but I want to show you 3 different ways to think about scaling into stocks or scaling out of stocks. So if you're thinking about scaling, let me share with you a couple of different variations maybe that you haven't thought about before. So first off, let's take a look at, well, what is scaling? Okay, what does scaling really do? Well, the act of scaling is, let's just say a stock is kind of heading higher over here. What you're doing is you're breaking apart this scale to say, hey, well, I'll go ahead and enter over here. This will be my first entry point, and I'll go ahead and add, let's just say $500, or you could also think of this in share amounts. So let's say 500 shares, okay? Another second part to that would be, hey, I'll add another 500 shares up here and then 500 shares a little bit higher. So you're really going in at different points as that stock is heading higher. And you can do the same thing as maybe, let's just say a stock is heading lower. You could also go at 3 different points. So the whole point behind this is to reduce your risk, because you don't really know if that stock is going to continue heading higher or continue heading lower. So you break these things apart, your entry positions, so that way you hopefully have a better average. Now, the disadvantage, of course, is, well, if the stock continues heading higher into higher prices and it works in your favor, well, it would have been better to buy all your shares at the beginning, because then you could get out sooner with a much larger profit, right? But of course, in the other approaches, well, if the stock headed lower, it's good you didn't buy that many shares. So I want to share with you today 3 different approaches to scaling, so that way you can see the variations to this. And the first approach really is the one that I've just shared with you. So we're going to cover these 3 approaches, and we'll call the first one linear or kind of flat, okay? The second one will be an increase amount, and then the other one will be decrease. If you're into music, it could be crescendo and decrescendo, but in either case, could increase that amount, and then you could also do it the other way where you're decreasing that amount. This will make sense in a little bit. So linear would be, let's just say we're doing 500 shares, 500 shares, 500 shares. Increasing that amount would be more along the lines of, let's just say I go 200 shares at the beginning, 500 shares next, and then maybe 800 shares the third time. And decreasing would be kind of the opposite. Let's say 800 shares, 500 shares, and then 200 shares. So these are your 3 different ways to approach it. So you could do a linear, increase, and kind of a decrease approach. So here's kind of the curves a little bit if you're having difficulty seeing them. So here's what we want to talk about is the linear approach is you're stacking things on a linear level. So as this, let's say, stock increases, I'm going to go ahead and do this 500, 500, and 500. Now, what you could think about as you start looking at things in this way is, well, you could almost break these apart in different trades. So this first trade, you don't have to think about saying, hey, this is where my out position is. Instead, you could think of, okay, well, my first exit, my second exit, and my third exit. So you tie these together to your exits, okay? So you're basically staggering your exit positions as well. So you could break it apart that way as you start thinking about scaling. So one of the advantages to this is you have a linear amount at every single entry point, and everything's kind of balanced. It's a good approach on one way because everything is working out okay to the upside, and it's working out the same way to the downside. The other approach is to look at things, let's just do it here as if we're looking again to the upside. So let's just say we're increasing now, and let's say we go 200 shares. Well, this is the approach of saying, hey, well, let me nibble. Let me figure out what this stock is all about. See if this is actually going to work out. So you're just kind of testing when you're doing the increase method. Okay, so you're testing to see, hey, is that stock going to go higher? If it does, well, say, okay, well, I'll go ahead and add a little more. So that's where you add in 500. And then you could go ahead and add in 800 if it continues and the stock proves to you that it's working out. So this is kind of the increase approach. And the advantage to this is really you're looking at a stock to prove itself to you. Now, the problem with this, these are all give and take. There's not one is better than the other. It's just a give and take. The problem with this one, with an increasing method, is that you're already at way higher prices and you have a much larger share amount at higher prices. The advantage, of course, was you didn't have a lot of risk at the beginning. You didn't have to put up a lot of capital, because if that thing actually started to go down, well, your loss would have been much smaller. So again, benefits, disadvantages, they're there, and they're a little bit different than the linear approach. Let me share with you kind of the third variation here. So if we now go and take a look at our decreasing approach, well, I could go really big at the beginning, let's say 800 shares. Then I might go 500 shares next, and then a little bit less, 200 at the end. So this is another different approach, and this is kind of you're decreasing your share amount. And this is good when you're fairly strong about the stock and you have a fairly solid breakout, but you don't want to put all your capital in at once. So you'll go in, let's say you go 800 shares first, then you might add a little more. Hey, it's still going, but the stock is stretching, so I'll only add 500 shares, and then you add a little bit more at the end. The advantage of this, of course, is that, hey, well, I'm getting in on a solid position at the beginning, and I can peel off and take shares off much sooner. And so I have a very solid position at a lower level. But the disadvantage, of course, well, if this thing started to actually roll over, it would create much larger losses than it would if you did the 200 shares at the beginning. So again, advantages and disadvantages, they all have them. If you're brand new to scaling and you're just trying things out, then I would say a good starting point is just do kind of this balanced approach. So this is more of a balance right here where you're even. So that's our linear way, where you're going in 500 shares, 500 shares, 500 shares, and staggering things, and it allows you to peel off those things as you move up in strength or downwards. The increase approach is very good if you're kind of testing a stock, if you're not sure about the stock. And the decreasing approach is really when you feel good about the stock and it's got a pretty strong breakout, but then you want to slowly get into it still through kind of this different way of scaling. Rather than going in, let's just say 1,500 shares right away, you might go 800, then 500, then maybe 200, and maybe another couple hundred shares here and there, depending on how large of a position you want to build up. If you're wondering how many times should you scale, okay, so the number of times, I'd say for most people, 3 to 4 times is about as many times as you want to scale in or out of a position. Once you start going into, let's say, 10 or 20 times, it starts to become irrelevant or not necessary or just more work than it's worth. But 3 to 4 times allows you to kind of average things a little bit and stagger things a little bit more than maybe just going in all at once and taking a position all at once. So doing things in scale really helps you to reduce your risk. And that's really the name of the game here in the business of trading or managing and investing your positions, is you're trying to build up your positions. With a lot of hedge funds, mutual funds, what they do is they build up their positions, and they're not always going in 500 shares, 500, 500. They might do 1,000 one time, 10,000 shares another time, 5,000 shares another time, and they're building things out depending on the price, and they try to find this kind of average price that they're in, and eventually when stocks break out, they're slowly peeling things off because they have such a large position that they don't want to move the stock in any one direction. So I hope this was helpful to looking at scaling at 3 different ways, with a linear approach, kind of an increasing approach, and a decreasing approach. The linear is all leveled. The increasing approach, you're adding more as the stock price continues moving higher, but it allows you to a little bit test at the beginning, but you do have a higher concentration of risk at higher prices. Whereas the decreasing approach allows you to put in a lot of capital right at the beginning, so having a good solid position right from the start, But if it sells off, you're going to take a much bigger hit than you would with kind of an increasing approach in scaling. Thank you so much for joining me in today's video. I hope you found it helpful. And if you did and you want to see other great videos like this, maybe get discounts to our books, courses, and other products that we release, then definitely get on the newsletter list right there. So that way you know of any other great training and material that we release. Otherwise, if you just want to hang out on YouTube, feel free. Just hit the face icon on screen and you can subscribe to our YouTube channel. Thanks again, and I'll see you next time.